The bank can monitor the credit risk at various levels. Let's look at each of those levels and understand them better. The bank can look at the credit risk at a geographic level. For example, a particular city or a particular zone, or the bank can look at a region or a state. The region could be, for example, the western region of India, comprising of states like, let's say, Maharashtra, Gujarat and Karnataka. Or it could be a particular state like the state of Maharashtra, or it could be a zone, for example, Mumbai zone, or a region for a bank. The banks which have their operations spread across various countries can look at the risk at the sovereign level. The sovereign level risk can also be looked at in two ways. The country rating is one of the indicators of the sovereign risk, and also the bank can look at the portfolio in that particular country and then appraise the risk based on the understanding of the portfolio. The bank has to obviously monitor the risk at the borrower or the corporate level. Whether it is a home loan, then in that case the particular individual to whom the home loan has been given, a car loan, a gold loan, or if it's given to a corporate or a business, then in that particular business level. The bank should look at their exposure at the group level. For example, Tata Group or Reliance Group. All these entities are closely related to each other, and their performance is impacted by the performance of the other companies in the group. So therefore, understanding the bank's exposure and the risk at the group level is also very critical. The bank should also look at the performance of the credit portfolio at the product level. For example, home loan is a product of the bank. Within home loan, the bank can look at, for example, reverse mortgages as a separate product. Likewise, the performance of credit card portfolio should be looked at separately. The performance of the vehicles loan portfolio, within that, commercial loans and passenger vehicles should be looked at separately. The bank should look at their portfolio exposure in a particular industry. For example, the exposure to the construction industry, within that, let's say, real estate, and that to commercial real estate, or the residential projects. Or the bank can look at, let's say, exposure to steel industry. The bank should also look at the credit risk in the exposure at a sector level. The sector is different from industry. For example, infrastructure is a sector. Within that sector, there are different industries like steel, power, cement, construction, etc. So understanding the exposure at the industry level as well as at the sector level is very critical for the bank. The bank should also look at the exposure at the currency level. If some of the bank's customers are exposed to the certain currency and its movements, in that case the bank should look at movements in those currencies and reassess the risk involved in dealing with those particular customers. The bank should look at other exposures, maybe certain class of borrowers who are exposed to a specific commodity. The commodity price rises will adversely impact that sector if that commodity is an input to produce the product of that particular industry or the sector. Likewise, those borrowers who have the debt equity ratio above a certain limit will be impacted by the rise in the interest rates. So that is another way of looking at the risk level for the bank. The bank should also look at exposure from the point of view of the assets it is financing. For example, the assets could be the assets required in the construction industry. These assets could be bought and then leased out to the construction industry. So any slowdown in, let's say, infrastructure sector impacting the construction industry will impact these people who are buying the machinery and giving it on lease to the construction industry. The bank should also analyze the risk on the basis of the maturity profile of the customer. For example, home loans maturing 3 years down the line should be looked at separately from home loans which are maturing 5 years down the line, because certain characteristics of that profile could be different. The same way it goes for the term loans which are given out, let's say, for 3 years versus term loans which are given out for 5 years. The bank should also assess their risk exposure from the point of view of the collateral. The gold loans is one of the examples. Any fluctuation in the prices of gold will impact the entire portfolio because the key collateral for those loans is gold. Likewise, if the bank has taken equity shares as a collateral, now the purpose for which the loan has been given and the product could be different, but the underlying collateral is equity. So any impact on the prices of equity shares in the market will impact that particular portfolio. So bank should look at the risk from the point of view of the underlying collateral as well. The bank should look at risk from the point of view of the derivative positions. If the bank has interest rate swaps or forward rate agreements executed with different customers, in that case, the bank should look at the exposure in terms of that specific derivative products and understand and assess the risk involved because of that derivative product. Last but not the least, the bank should also look at the exposure to the counterparties. For example, the bank could be dealing with different investment bankers or could be dealing with different other bankers, and understanding the counterparty risk in each of those cases is very important for the bank. I hope with this you have understood how complex it is to monitor the risk at different levels in a bank, and that is why the IT systems have become extremely important or critical for running the business of banking. I hope you like this video. If yes, please do subscribe to my channel. Thank you very much and cheers.